Good afternoon, everyone, and thank you so much for making time to join us for this investment committee meeting. I know that everyone has been really anxious to hear about what we, Mosaic, are going to do with this pipeline opportunity that we have in the city of Lakewood, and that's exactly why we've convened this meeting today. We brought the entire deal team together in one room because we know that the committee has questions about investing in workforce housing, especially with a complicated business plan and uncertain partnership terms. So allow me to introduce our team. My name is Maribel, and I manage Mosaic's fifth investment fund. On our deal team, we have John, we have Matt, David, and Andrew. So we came together, and we wanted to think about what is it that's important in our fund right now. Of critical importance is that we have $425 million left in uninvested capital and a year and a half to invest. Our portfolio currently has healthy exposure to office and redevelopment, and so we're seeking an asset that is defensive, income generating, lower risk, and that will provide our fund higher multiples. So this deal that we're considering right now is a residential portfolio located in northern Lakewood. It consists of 4 properties totaling 1,000 mixed income housing units. The local sponsor, 512 Development, struck a deal with the city of Lakewood to create and maintain 2/3 affordability across this portfolio, and they've given us at Mosaic a first look. This deal has both its strengths and its hurdles. On the one hand, we like that this deal is income generating, we have a local and experienced partner, and we're in a supply-constrained market. Yet, this deal has multiple stakeholders to account for. We have a local sponsor who's seeking co-control in this 50-50 venture, and a high-touch business plan with many moving parts. In order to fully evaluate this deal, we thought about the 4 key levers that would drive whether or not we choose to invest: the market, the asset itself, the partnership structure, and lastly, how all of this fits within our fund. Before diving into the details of this deal, John, can you tell us if this is a market that we'd like to be in?
Absolutely, Maribel. So we like this market for several reasons. Perhaps the most obvious reason is that we like urban markets, given the strong secular trend toward urbanization across the US today. Lakewood also has strong job and population growth, driven in part by TAMI tenants, technology, advertising, media, and information, and this should drive strong underlying demand for rental product. So in terms of the market for rental product, we feel that there should be supply constraints, especially given the fact that prices for for-sale housing have reached exorbitant levels in recent years. And despite the fact that rents have reached record high levels over the past 15 years, vacancies have remained low and steady, averaging about 4.8% over the last 15 years. In terms of the market for workforce housing itself, which is an important component of our investment thesis today, there's excess demand for this kind of product in similar markets. So I know that some of you had questions about the political risks of investing in markets with record high rents. So I'm bringing in our political and economic consultant, Eric, to tell us more about this.
Great. Well, good afternoon, Mosaic team. I'm happy to be here today to talk a little bit about the political and economic situation on the ground in Lakewood. I work closely with the city, especially their housing policy staff, so I hope my insights can be helpful for your discussion today. So as John mentioned, it's a good time to be a landlord in Lakewood. Rents are high and vacancies are low. And so why is this? Well, it was true in 1992 and it's true today. It's the economy. Cities like Lakewood have been adding jobs at a much faster clip than the US overall. As more jobs are coming to city, more lifestyle amenities pop up to serve those employees. With better lifestyle amenities, more people are willing to stay in cities, which in turn drives more employment growth. Hence the virtuous cycle between jobs and lifestyle amenities. And so we all know why urbanization can be good. Denser cities can be more environmentally sustainable, as well as drive economic productivity. However, not all is good in the eyes of Lakewood. So in 2011, rents were sitting at about $2,100. Had those rents grown by CPI over the ensuing 6 years, rents would be sitting at about $2,300. Instead, they're closer to $31, an $800 increase over just 6 years. And so there are multiple reasons why this is happening. But the laws of supply and demand are a key player. So cities like Lakewood aren't building enough housing to house enough of their growing population. And so the reasons for this are structural, such as restrictive zoning, NIMBYism, as well as high construction costs. And so as you can imagine, players from across society are trying to do something about the situation.
Eric, can you actually share more about who those people are and what they're doing?
Yeah, definitely. So there are three main players. So the first one are governments. So states like New York and California have enacted in the past year new rent control laws, while cities like Minneapolis and Portland have upzoned major parts of their city to create more density. Innovators are also trying to get in on the mix. So people are trying to crack the nut of modular housing. People have been trying to do this since I got into the business 20 years ago. But because the crisis is so bad, maybe they'll actually succeed this time. Operators are also trying to get people to live more densely, such as Star City and Common, in co-living arrangements. And finally, these employers who have been adding lots of jobs to these cities have donated billions of dollars to help ease the affordability crisis. And so as you can imagine, Lakewood is eager to create more affordable housing in their city. They think that the best way to do so is to leverage their precious resources to attract private capital to create long-term affordability. And so in sum, as I mentioned at the beginning, it's a good time to be a landlord in Lakewood. However, because of the political pressures, I think it's an even better time to be a landlord of workforce housing.
Great, thanks, Eric. That's super helpful context on the political aspects of this deal. So turning back to the economics, in spite of the strong rent growth that we've seen over the past 15 years, as you can see here, vacancy levels have remained low and steady, averaging about 4.8%. And this contrasts quite sharply with the overall experience for the US. In terms of, in markets like Boston, DC, and the San Francisco Bay Area, we've seen that market rate developments have become unaffordable for most workforce households. And it's really only the small workforce households that are generating at least 100% of AMI or greater that are able to afford these rents. So what this means is that there's excess demand for workforce housing, which is outstripping supply. And since this is a persistent problem due to the economic and political reasons that you mentioned earlier, Eric, the cumulative unmet demand for workforce housing is growing and growing. So Maribel, I think it makes sense to invest in assets such as the mixed income residential portfolio that we're evaluating today.
So this does sound like a market that we'd like to be in, but I imagine that it's going to be difficult to find an asset that meets our target returns. Matt, can you dive into the particulars of this asset?
Yeah, absolutely. So we will be making a lot of improvements to this portfolio, but we like the portfolio even before improvements. First of all, it's institutionally owned previously with about $60,000 per unit in capital improvements made during the previous buyer's hold period, and that makes us feel more comfortable with the fact that the portfolio is 1970s and 80s vintage. Secondly, it's an irreplaceable portfolio in a set of neighborhoods that is rapidly transforming, and that should help to buoy rents. Third, the purchase price is below the replacement cost. That's a general trend we're seeing in the market, and that'll help to limit future supply and therefore competition. And fourth, we like the portfolio's stable cash flow. A large percentage of the units are public voucher units, which are backed by the federal government. As far as our value add to the portfolio, there are two key components. First, we're striking this deal with the city for a tax abatement in exchange for setting aside affordable units. And secondly, we are renovating units and putting in other capital improvements to common areas, as well as modernizing the building systems. This final aspect here allows us to improve electrical efficiency as well as add for our ability to collect utility reimbursement income, which is a tremendous value add to our portfolio here. As far as the 5-year business plan for the units themselves, we will be renovating market rate and voucher units as they turn over and during our hold period. And on the affordable side, we'll be starting with 0 deed-restricted affordable units and ending with almost 200 affordable units by the end of our hold period, all of which will be renovated. And as I mentioned, this is an intensive plan, but we think we have the right partner in 512 to help us make this happen. 512 is local and experienced. Therefore, we think that they are equipped to work directly with tenants to keep them updated on the renovation progress, as well as educated on the upcoming utility reimbursement plan. Additionally, because they're local, we think that they have the right local working relationships with contractors to help with ongoing renovations, as well as maintain close working relationship with the city. We are going to be adding a lot of value here, but there is still work to be done by the next buyer to move towards the full affordable unit goal. Ideally, we'd like to sell to a core buyer, which would lead to the highest sale price, and we think we can do that given that we've done the bulk of the work here in striking this tax deal with the city and starting the renovation process towards the affordable unit goal. And we also think that given the secular trends that we've talked about, that this type of workforce portfolio in a primary market is in high demand. Now, as an additional mitigant on this factor here, we've estimated an additional $3.5 million the next buyer would have to factor in and invest during their hold period, and we've subtracted that from our exit value. We're spending a total of $44 million in capital improvements during our hold period, and we're adding about $80 million in total incremental exit value, the majority of which you can see comes from the submetering and utility reimbursement plan. Now, when we factor in all of the income that we're generating from these additional improvements during our hold period, the attributable multiples are all positive, including the cogen upgrades, which was something we considered as an additional potential optional investment. Now, I mentioned we like the deal's stable cash flow. We like that we can use about $36 million in operating cash to fund the bulk of these $44 million in total capital improvements.
This all sounds good, Matt, but team, let's cut to the chase. What are the returns on this deal?
No problem, Maribel. So I think one of the great things about this deal is that the city is leveraging the in-place voucher income, which is almost market rate, to attract an investor now and preserve affordability long term. So as a result, our NOI during our 5-year hold period is 19% growth from year 1 to year 5. We're buying the property and doing capital improvements for $496,000 a unit, and we're selling it for $548,000 a unit. We're cash flow positive by year 3 after we're done with required capital expenditures, and the utility submetering plan is in place. We also thought about what would this look like as a market rate project. Obviously, the value of the tax abatement at over $6 million difference in terms of your property taxes every year is a huge benefit. But we also felt like that given the conditions of this market, a market rate project would expose us to additional vacancy risk, as well as additional expenses and leasing costs as landlords in the market compete with each other for tenants at the high end. We looked at 4 main sensitivities to see how our returns could be impacted in some downside scenarios. The first is that since the affordable units are pre-designated, we could have a larger than expected market to affordable turnover ratio during our hold period. The second is that because some of these tenants are low income, they might not be used to paying for utilities separately. We wanted to look at what would happen if we weren't able to realize the full utility submetering recovery amount. And then we looked at your traditional macroeconomic sensitivities like rent growth and exit cap rate. The takeaway here is that the asset-specific sensitivities, the market to affordable turnover rate, and the utility submetering recovery had less of an impact on the model than did the general market conditions, so rent growth and exit cap rate. And the largest of those was the rent growth, which we put at 1.5% for market and voucher units. That resulted in a 142 basis point decrease on unlevered IRR, and we haven't really seen that low rent growth over any 5-year period in recent history. So the takeaway here is that the base case does fit our target returns, Maribel. Our levered IRR is 13.1%, our multiple is over 1.8, and in either of the 2 downside scenarios, whether we're subject to capital markets risk from an exit cap expansion or subject to rent growth risk, we're still hitting our target multiple. One of the great things we also liked about this property is that the cash flow allows us to lever up pretty significantly. So even with a 70% LTV loan, we're able to achieve a year 3 debt service coverage ratio of 1.69. So as long as the lender offering us that quote is willing to give us favorable recourse, i.e. limited recourse, low prepayment penalty, and potential flexibility on extensions, we'd like to move forward with the high leverage options. So I feel pretty good about the underwriting for this asset. My only question is about who the partner is and what the deal terms are with them.
Those are great questions. Andrew, would you mind walking us through your plan for the partnership structure?
Sure. So as you know, Maribel, we don't see a lot of 50-50 deals land on our desk, and initially the idea of a brand new partner also wanting co-control in a 50-50 deal was a little bit too much for us to stomach. That said, 512 did bring us this deal in a tough market to get into, and at 50% interest in this deal, they certainly have plenty of skin in the game. So there are some things that we can do if we think holistically about this deal to structure it in a way that's a bit more appetizing. And that starts with looking at the motivations of both parties involved. So while we're certainly both concerned with a strong bottom line, the bottom line for 512 also includes producing a number of affordable housing units, getting in good graces with the city, and hopefully doing more deals with the city in the future. Whereas our bottom line, really the ideal outcome is just risk-adjusted income and that financial bottom line. And that all starts with the business plan that Matt outlined earlier. And so the first contract stipulation that we would like to include is having approval rights for all major financial and business decisions, for example, all capital events, and really give us a seat at the table for all major discussions. Now, we also have a few actionable arrows in our quiver that can encourage execution of the business plan in the here and now. And that starts overall with the promote structure. We also have asset management fees and the performance guarantees, which deal more with the day-to-day. Now, to go over fees, we look at fees and we like to incentivize future performance. And so 512 has requested an acquisition fee. They haven't given us the amount yet, but we've chosen to strike that, at least from our first run, and focus more on the back-end fees and encouraging them to add value to this deal. With the asset management fees, we've chosen to defer half until the utility submetering plan is completed because that is so integral to our overall underwriting. And then again, on the promote, as I mentioned, we're bumping it up to a 70% promote after a 12% IRR, which we feel like incentivizes 512 to complete the plan and hopefully see some upside on the back end. Now, you can see here that we've structured this in a way where the overall compensation to 512 is pretty comparable between the two, except on our new proposed structure with the upped promote, they're allowed to realize any additional value that they create on the back end. We feel like it's good for both parties. Now, in summary, I think this deal may actually end up being less of a tug of war and more of a balancing act. I think if we think about the right terms to add into the contracts, the interests of both parties, we can really produce some nice returns for everyone.
I do like your proposed partnership structure, Andrew, but what do we do next to actually achieve this for this deal?
Yeah, so I don't think we're just quite ready to sign on the dotted line just yet. I mean, keep in mind, as I mentioned, this is a first-time partner. This is a 50-50 deal, co-control. These are things that we can't completely mitigate just with contract terms. We need to start spending more time with 512, doing our full due diligence on them, and developing a working relationship. Because at the end of the day, we're going to be in this deal for 5 years with them, and so we need to know we have a partner we can trust. That being said, they are experienced in this market. And so, I think if this all lines up at the fund level, I think we could produce some nice returns and it'd be wise to continue negotiations.
Well, let's walk through that now. Our fund is seeking risk-adjusted returns. And we're seeking an asset that's income generating, defensive, like multifamily housing, and that provides our portfolio with some balance. But we're getting more than IRR in this deal. And we didn't get to Fund 5 by being short-sighted and about thinking about this opportunity in isolation. By establishing ourselves as a trusted financial partner in the city of Lakewood, we're really setting ourselves up to do more lucrative deals like this with the city and with the local stakeholders. So we've now reviewed the 4 key levers driving this decision. The market is strong. The asset meets our targets. We do have some questions about the partnership structure. But overall, based on our team's analysis, I feel like this opportunity matches our fund. So we believe that with the potential to negotiate partnership terms with 512 Development and with our plan to mitigate this complicated business plan and having multiple stakeholders, that we feel confident in recommending that we would like to proceed with partnership negotiations with 512 Development. Thank you all for your time. We are Team Strada, and we will now take any questions.
Yeah, so I think the way that we kind of looked at that is this, we didn't get a ton from 512s in, at least in terms of initially what they're looking for on the whole. So I think this is really our first swipe at it. Again, it's a long process negotiating all the terms. If we don't get exactly this, I wouldn't say we're ready to walk away by any means. Again, they have leverage because they're bringing us this deal. But we've tried to structure this in a way that we feel is fair, and hopefully there's not too much movement on the contract terms. Yeah, so I think what we sort of envisioned is that 512 has the knowledge, the expertise in the local market to execute the business plan. And so we see them kind of taking lead on that. However, we wanted to structure in something that allowed us approval rights or veto rights, again, for major decisions, just so we can hopefully incentivize starting the conversations early and I guess having a conversation about those major decisions. Yeah, that's a good question. It's something we discussed quite a bit. I mean, a general kind of market contract term for us is the buy-sell. That's something we'd hope we'd never get to, and we hope we have a great relationship with them. If we were to have that, I think we would try to negotiate some sort of like 3-year lockout period and completing the sub-metering plan so we could add some value there before that happened. But again, we're hoping by working up front with 512 and developing a strong relationship that we would be able to come to a good agreement there.
I think just not, we're not in the business of sort of predicting the market. And we don't know exactly where workforce housing will lie at our targeted sale date. So I think that would be just cyclical risk. I think the benefit of workforce housing is that it's a little bit less sensitive to those cycles. But even with that, when we looked at all of the different things that we thought could go wrong, that had the most impact.
Yeah, so I mean, as far as the overall business plan goes for renovations, we'll have renovated 2/3 of the units when you look at market rate, voucher, and affordable over the hold period. So there'll be about 1/3 left. And when we're thinking about ongoing turnover of these units, according to the assumptions that we use, or I think it's a 3.5% turnover for voucher units, it's pretty slow trickle over the time period. So we think that there's going to be some amount of turnover that's going to happen into the future for any buyer. And we feel like, given that we're essentially giving the buyer a credit on the back end, on our back end to help fund those improvements, and because there'll be more of a trickle, we'll have done the tax deal, the utility submetering, the cogen. 2/3 of the unit upgrades will all be done at that point. We'll have really started the process. We think that we've really done the vast majority of the work, and then again with that seller credit, help them with funding their improvements. As far as we've accounted in that we will have some value adjustment a little bit, but we do think it definitely makes sense for a core buyer, especially with the different urbanization trends and affordability that's going on.
I think just because it's a pretty short hold, the exit value is really the driver, and we also only we didn't originally, when we did the first sensitivity, we sensitized like no recovery, and we talked about it. We didn't think that was sort of realistic. We thought that most people will pay their utilities. So what we ended up sensitizing was basically that half of the people in unrenovated voucher units wouldn't pay. So it wasn't a full deduct to the utility submetering recovery. It was just a partial.
We didn't. I mean, we budgeted the full equity for any operating deficits on an ongoing basis. We factored in the full amount of equity we'd need to draw over the first, essentially 3 years. We'd need to be drawing equity. So we do have that into the model as far as, draws in. We did, yeah. I mean, there is going to be some funding of equity in years 2 and 3, though, as these renovations continue, and then before the full improvements kick in. And then like our cogen upgrades that are kicking in, those type of things in year 3. So yeah, we do assume equity draws in year 2 and 3.
Thank you so much, everyone.
Thank you.